Welcome to The Explainer. Today, we're investigating an invisible economic force that is constantly, and I mean constantly, reshaping our purchasing power.
So let's start with a pretty fundamental question. Why does the exact same amount of money buy fewer goods and services as time goes on? It's a phenomenon that has literally toppled governments, rewritten history, and quietly drained household savings. We are, of course, talking about inflation.
Okay, let's quickly map out our journey today. We'll hit what inflation is, a history of rising prices, measuring the cost of living, what causes inflation, the winners, losers, and effects, and finally, how we control inflation.
Section 1. What is inflation? The erosion of purchasing power.
To really get a grip on what's happening to our wallets, we first need to look at inflation at a macro level. Now, the absolutely crucial point here is that inflation isn't just about one item, like, say, tomatoes getting pricier just because people suddenly prefer them over cucumbers. That's just a shift in consumer taste, right? True inflation is the rate of increase in the average price of goods and services over time. And because of that, it corresponds to a reduction in the purchasing power of your money. Basically, when the general price level rises, each unit of currency buys fewer goods. It's a systematic devaluation of the cash you're holding.
Section 2. A history of rising prices, from ancient empires to hyperinflation. What's really wild is that inflation is definitely not some modern glitch in the matrix. It's woven right through human history. As far back as 330 BC, right after Alexander the Great's conquests, the ancient world saw documented inflation. Fast forward to the 270s AD, and the Roman Empire is suffering massive inflation. Why? Well, emperors started debasing silver coins, literally melting them down and mixing in cheaper metals like copper just so they could print more money. Then, in 1324, you've got the Malian king Mansa Musa. He spent so much gold on a trip through Cairo that he actually depressed its value in Egypt for over a decade. Moving into the 16th century, Western Europe hit a price revolution, with prices jumping sixfold over 150 years, mostly thanks to a huge influx of gold and silver from the Americas. And then jumping to modern times, we see absolute extremes, like Zimbabwe in 2008, where an out-of-control money supply led to an estimated hyperinflation rate of 500 billion%. Unbelievable, right?
Section 3. Measuring the cost of living. Tracking the price of everyday goods.
So let's look at how economists actually measure this invisible force today. To figure out the average consumer's cost of living, government agencies don't just throw darts at random prices. They use a highly specific tool called the Consumer Price Index, or CPI. They run surveys to build a representative basket of commonly purchased household goods and services. We're talking rent, groceries, haircuts, the whole shebang. They then track the average price change of this fixed basket over time. If the cost of the basket goes up compared to a base year, well, that percentage change is your consumer price inflation.
But, not all inflation measures are created equal. You've got headline inflation, which is the broad index covering all the consumer goods in that basket. Central banks, though, usually prefer to look at core inflation. Why the difference? Because core inflation intentionally strips out volatile, short-term price fluctuations in food and energy. Think about it. A sudden winter freeze might spike crop prices, or a geopolitical conflict might send oil prices skyrocketing. Stripping those out actually reveals the true underlying persistent trend of inflation in the broader economy.
Section 4. What causes inflation? Supply, demand, and the money supply.
This naturally leads us to ask what exactly triggers these widespread price hikes. Well, there are three main culprits. First up, demand pull inflation. This happens when aggregate demand exceeds an economy's production capacity. Put simply, you've got too much money chasing too few goods. Second is cost push inflation. This hits when overall supply drops due to a shock, like a natural disaster, or when production costs, say the price of oil, suddenly shoot up. Producers basically just pass those higher costs right onto us, the consumers. And third, we have built-in inflation. This one is entirely psychological. When people expect prices to rise, workers demand higher wages to keep up. Firms then raise prices to cover those higher wages, creating this nasty, self-fulfilling wage price spiral.
Now, economists have been debating the roots of these triggers for decades. If we look at the macroeconomic theories neutrally, we see two major historical camps. The Keynesian theory focuses heavily on aggregate demand, arguing that prices respond to shifts in private and government spending, investment, and fiscal policy. On the flip side, you have the monetarist theory, famously championed by folks like Milton Friedman. They argue that inflation is always and everywhere a monetary phenomenon. In their view, it's primarily driven by the money supply simply outgrowing the real production of goods.
But welcome to the 21st century, where we're seeing completely new drivers enter the chat. we're now experiencing what some are calling climateflation, where extreme weather, like severe droughts or massive floods, disrupts agricultural productivity and drives up global food prices. Add in complex energy shocks and the kind of massive global supply chain meltdowns we saw during the COVID-19 pandemic, and you've got a very modern recipe for unpredictable inflationary pressure.
Section 5. Winners, Losers, and Effects. The double-edged sword of rising prices.
Here's something really important to understand. Inflation doesn't hurt everyone equally. It ripples through society in very different ways. So who wins and who loses? The definitive losers are those on fixed nominal incomes, like pensioners whose checks don't magically adjust for the cost of living. Cash savers and lenders get hit hard too, since the purchasing power of the money they hold or are owed just evaporates. But surprisingly, there are winners. Debtors holding loans with a fixed nominal interest rate, like a fixed-rate mortgage, actually come out ahead. Why? Because as inflation rises, their real interest rate drops. They're effectively paying back their loans with currency that's worth less than when they first borrowed it.
But the most profound danger here is the stealthy, quiet erosion of a population's standard of living. This happens whenever wages just fail to keep pace with the rising cost of everyday goods. Real income falls, and families can simply afford less. It's basically a hidden tax on everyday life. And beyond individual wallets, unpredictable inflation creates massive economic friction. You have what economists call menu costs, which is the literal and figurative expense businesses take on to constantly update their pricing. Then there are shoe leather costs, the time and effort wasted making frequent bank trips just to avoid holding depreciating cash. If inflation gets really bad, people start hoarding durable goods, which creates completely artificial shortages. And at its absolute worst, it sparks severe social unrest. Historically speaking, soaring food prices were a major catalyst for both the French Revolution in the 18th century and the Tunisian Revolution in 2010. But actually, hold on a second. It's not all doom and gloom. Moderate inflation does have some positive macroeconomic effects. First, it kind of greases the wheels for labor market adjustments. Nominal wages are notoriously sticky. Nobody wants to take a pay cut, right? Moderate inflation allows real wages to fall without cutting nominal pay, which helps the labor market find equilibrium. Second, it gives central banks room to maneuver. If inflation is slightly positive, interest rates have room to be cut during a recession, keeping us out of a devastating zero-rate liquidity trap. Finally, there's the Mundell-Tobin effect, which suggests that inflation nudges savers to move their money from cash hoards into actual investments, potentially stimulating economic growth. Section 6. How we control inflation. The tools of central banks.
Because deflation causes economic stagnation and hyperinflation causes catastrophic collapse, governments desperately need to find a middle ground. And for most developed nations, the magic number is 2%. Today, central banks from the US to New Zealand practice inflation targeting. They aim for a low, steady, and predictable rate of about 2%. This gives the economy those positive benefits we just talked about while minimizing all that destructive unpredictability.
So how does this translate into actionable policy when that target is threatened? Step 1. The central bank observes the economy overheating and prices rising way too fast. Step 2. They implement a contractionary monetary policy, mainly by raising interest rates. Step 3. Borrowing becomes more expensive for both businesses and everyday consumers, which cools down aggregate demand. People buy less, companies invest less. And finally, Step 4. As a result of all that, pressure on the economy eases up and price growth stabilizes. On top of adjusting rates, central banks rely heavily on an invisible yet incredibly powerful tool, their own credibility. If a central bank has a rock-solid reputation for being tough on inflation, the public tends to believe them when they say they'll fix it. Managing inflation expectations is absolutely vital. By keeping the public confident that prices will eventually stabilize, central banks can actually prevent panic from turning into that dangerous, self-fulfilling wage price spiral we touched on earlier.
So, knowing that our own collective expectations can quite literally drive economic reality, we want to leave you with this final thought. How will your anticipation of future prices alter the financial decisions you're making today? Because understanding inflation isn't just about reading a chart. It's about seeing the invisible forces shaping the world around you.